Okay, so today we got a team question. Hopefully y'all watch the video so you're ready for it, but if not, let's just make sure everybody, the basics of it. First of all, there's the equation that if you're a finance major, you know better than any other equation. What equation is that? KE equals what? You should risk-free rate plus beta times the market risk premium. Is it beta times the market risk premium or the market risk premium times beta? It doesn't matter. All right. I had graduate students saying, wait, you switched the formula. It doesn't matter because you're multiplying. All right. So that's the equation. You should know that equation. We use that equation so much. When I took the CFA exam, I took a review session. And at the end of the very last day, these two guys on the front row, they go, wait, what's that CAPM thing? And I was like, I think I'm ready. And then the exam, the first part was written in the morning, 3 hours of writing, which I don't think I could do anymore. And I felt pretty good about it. And the afternoon was multiple choice. And like 10% of the questions were just take the CAPM formula and plug in the numbers and you got your answer. I came out of the afternoon knowing I passed because it was so simple. So that's the formula. If you're a finance major, don't know that formula, you missed something somewhere. You should have had that practically in every single class you've taken in finance. All right. And then beta is a 4-step process. What's the 4 steps? Type of company. So what are your 2 types? Defensive cyclical, second thing. Upper leverage, third thing. And the last one, history. All right. So that's today's team question. That's paper 3. And it's going to be on the exams. So I'm going to do all this. I do practice this exact same thing in my business finance class. So we keep doing these things over and over again. All right. Now, my printer is broken at home, so you're going to have to either take this off of the screen or come take a picture of it. But there's the question. So you may have to take a picture of it. So targets the company. I've given you all the data you need to come up with the discount rate. You have to come up with your own beta. So I have to give you the beta chart. So take a picture of that, and then I'll show you the beta chart. All right, start turning them on. Got them.
Well, if you look at the peak right here, it's around 1.2, and that top one is 1.2, and it seems it's kind of around 1.2. You hear about it?
Something new happened?
You know, or trying to
Oh yeah, I've seen that in the news today. Yeah.
Yeah.
I really think Trump's setting up a fall guy in case we get a recession.
I mean, the way we come like today, I mean, basically that whole 9% upswing, this all got eaten up already. We're back down. I'm like,
Yeah, gold's up.
that bear market.
Yeah, it's pretty negative. It's still not a bear market though, so it hasn't been that bad. Yeah, it could get much worse. Well, I hit a bear market intraday, but we're down 17%, so it's not. We were down 19%. Yeah, last week was a huge rally. So yeah, it's been all over the place. Yeah. Day traders can probably do something with it. All right, turn them in.
Last time
Teams 7, 1, 3. How many teams do we have? 7? Is there a team 7? Team 1, 3. Where's team 3? Are y'all close? Thanks. Team 3 and 7. Where are y'all? 3? Who is 3? Do we have a team 3? Okay. Team 7, right? Okay. Oh, well, all right. Okay. So this is pretty big question on the first exam. This is one you really feel comfortable with. The issue you're going to have is every professor does it a little differently. And it's really frustrating, but it doesn't matter how they word the question, you got to be able to handle it. So you got my approach to doing it. So you know the formula, so KE equals risk-free rate plus beta times the market risk premium. But some professors do what? KE times the market risk premium times the required return on equity minus the risk-free rate. That's when you see that, you know you're in college, because no one in practice does it that way. College does it like that almost 100% of the time, but no one does it like that. Everybody does it like this. When you get into practice, kind of get rid of that one because you won't see it again. All right. But they're the same thing, right? What's the definition of market risk premium? It's expected return or required return on stocks minus the risk-free rate. All right. In this case, you're calculating the required return on stocks and subtracting risk-free rate, but you're just plugging it in as the market risk premium. So here, what did y'all say the risk-free rate was? Yeah, so 4.2%. What was the expected return on stocks? Why are we using expected return on stocks and not the required return on stocks? Well, we're assuming they're the same thing, right? So that's what is called the implied approach. All right. I don't know what the other professors do, but you should think the implied approach because it's the overwhelming approach today. Some still use the historical approach, and I've seen a lot of professors do the historical with way too little history. I've seen some come up with the market risk premium off of the last 10 years. You would never do that in practice. So Ibbotson, who's the famous one on all of this, he does the historical approach, but he goes back to 1927. So he has a long, long period of time. But I have seen exams and others that just go back 10 years, and that's just not the way to do it. So expected return on stocks, you've got the economy. What did she think about the economy? 2% productivity, 1% labor, 2.5% inflation. What does that give you? 0.02 plus 0.01 plus 0.225, so 5.5%. That's what she thinks the economy grows. How fast does she think corporate earnings are going to grow? The same number. All right. So that's the economy and corp earnings growth. It's the same number for her. So the expected return on stocks is going to be the expected corporate earnings growth plus two yields. What yields do you have? Dividend yield and the buyback yield. And I'm recommending you use the buyback yield in your paper 3 because it's going to give you a much more reasonable answer. Now, I gave you targets dividend yield. Where are you going to use that 3.4% in this exam? Nowhere. Why did I put that in or see if I could throw you off? Same thing on paper 3. Don't give me the expected earnings for target, growth in earnings for target. It has nothing to do. This is entirely the stock market. So when you come with the market risk premium, you should not talk anything about your stock. You don't care what their buyback yield is, what their dividend yield is, what their expected earnings growth is. It's only the economy and the stock market. So the dividend yield for stocks is 1.2%. The buyback yield for the stock market is 1.5%. You can use that 1.5% in your paper 3 if you like. So that gives you the expected return on stocks of 8.2%. So your market risk premium is what? 8.2 minus 4.2. Did y'all get 4%? Anybody? Look right. All right, good. And then beta. So what kind of company is this? So it's Target. What do we call Target? Y'all call it a discount store? I call it a discount store. So you have a couple of things here. It's a discount store. What else do you know about it? It's also a grocery. What does that sound like? High beta or low beta? So, but it's not Walmart, it's not Kroger's, so it's higher than those, but lower. So I would say below 1, but you can argue on the exam and I can disagree with you as long as you're rational with that. You can target as higher end, definitely. Remember, the question is, if we had a recession, would they suffer more than the average stock or less? The question is not would they suffer from a recession. It's all relative. So are people cutting back more on buying Ford SUVs or cutting back more on the trips to Target if we have a recession? That's really what you're asking. All right. Then the operating leverage, well, they probably have hourly workers, right? That probably gives them low leverage. They have pretty stable gross margins. Yeah. whatever you're gonna say there, but the ultimate is the volatility of margins. And what was their volatility of margins? What did you notice here? Their net margin standard deviation was 0.84%. How does that compare? It's one of the most stable out there. So is very stable. So that implies below 1, even more below 1. Financial leverage, what did you see there? So a little bit high, right? 78%, so high debt pushes up closer to 1. And what does history say? Median. Most students go with the median. I heard one team talking about where it was recently. You can do that, but I tend to look more at the median because if you go where it was recently and you're right here, then it shut down pretty quickly. So, and it's coming back down. So do you really think a target is a 1.2 beta stock? I don't. It doesn't feel like a 1.2 beta stock to me. History suggests right around 1. The type of company and its operating leverage suggests that it's probably in the more 0.9 range. Could be 0.8 with the groceries. But, you know, it's up to you to argue it. I might use a 0.9 for targets. Most of y'all probably used 1, I would think. If you use 1.2 and your only argument is that's what it is now, I mean, that's what Yahoo Finance shows. That's probably not going to be as strong. That's not as strong of an answer. You really, beta is something we want to look at over long term. What's the real beta we're looking for? What it's going to be going forward? Which going forward, if you're sitting right here, is this a good estimate? Not a very good estimate. If you're going forward for a beta, you're sitting right here, would that 0.6 be a good estimate? No, going forward is going to be higher. So the median gives you, most students pick something pretty close to the median. Paper 3, you're probably going to pick something close to the median, unless it completely contradicts the rest of your paper. I think 0.9 makes sense. So that gives me a KE, the risk-free rate, plus the market risk, or plus beta times the market risk premium. I get 7.8%. Your KE is going to be in the 6 to 10% range more than likely. It's unlikely it's going to be a really radical number. So any questions on that? This isn't an essay question, but you do have to do a little bit of writing to justify your answer on this. There really are no essay questions on this exam, but there are a few places you have to write some stuff. This is one of 2 questions where you have to write a little bit extra. Doesn't have to be an essay or lengthy, but just give me some sense of what you're thinking. Same thing on paper 3. On paper 3, on the operating leverage, don't just look at the volatility in net margins. Give me some words. Are they hourly workers? Are they salary workers? Did they have a union? Did they have a lot of property, plant, and equipment? Those are kind of things that are going to impact their operating leverage, right? I think I might put this Excel out there, but boy, it's got all kinds of stuff. It does have the stock valuation for Walmart, so I do want to get y'all that, but it's a mess, right? It's all over the place. So at least gives you some practice. So I'll try to remember to put that out there on Canvas. All right, good. So Wednesday we'll do stock valuation. That usually is the easiest question on the exam. About 85% of the class gets that exactly right, because that's just plugging numbers into a formula. If you have a professor give you the dividend discount model as a formula sheet, you're in the wrong class. If you're a finance major and don't know the Gordon growth model by memory, you're in a lot of trouble. You went to the wrong school. If they ask you that in an interview, tell them you went to A&M, because that's a formula every finance major knows, is the Gordon growth model. All right, let's talk stock valuation. So last time we did what you're doing on papers 3 and 4, which is pretty standard. If you take my security analysis class, and if you're interested in a class, I've had a few students say, well, it's 2 semesters. I can't do 2 semesters, but it's really you only have to take one of the semesters. what you're doing on papers 3 and 4 is one of the approaches we're going to do there. I'm really excited about the class. I'm changing it up quite a bit. It's going to be really powerful for interviews. It's going to be, in the past, it's been a really, really tough, lengthy linking paper, but this time it's going to be more presentations and much more volume. And I'm going to give you several templates that you can use. In fact, we're going to be alternating templates so you can see different versions. And the templates will look a lot like what you're doing in paper 3 and 4, but most of them are going to look more like the relative value analysis. And I'll show you the most famous template, which is the investment banker approach, which you'll see a lot. We'll use it in the security analysis class so you really see what's the most common. What I'm going to do is there's so many free templates out there. Capital IQ has a whole dictionary of templates you can pick from. So I'm going to this summer find 3 or 4 of those. The class is set up to do, at the beginning of the semester, you team up on a sector like consumer staples, and then we break that sector into 3 industries. And so you'll essentially have 3 presentations. You'll do one industry, get a buy list, you'll do stock presentations, you do second industry. And so what I'm thinking is we'll do a different template for each one of those so you can start seeing different approaches. So Capital IQ has several. I like the Capital IQ one. I use it in that class. It works really, really well. And then Bloomberg has several templates. And we're just going to be bringing them in and trying them out and see which ones. They're all linked. So all you got to do is load the template and change the ticker and everything else populates. It's pretty amazing, and you just use it. So I want to get you in the habit of using those type of pre-formatted ones. But relative value is extremely important. If you took my business finance class, we did it in there. So you're going to see this again. That's probably only Emilio. I don't know what the rest of y'all, did y'all do relative value analysis before? Does that sound familiar? So this might be the first time. I might be the only one who does it in 3013. It's pretty important. So let's go through this. What I'm going to do is set up relative value analysis compared to what the other approaches. There's 2 other approaches. In my security analysis class, we're only going to do 2 of the 3 approaches. I used to do all 3 of them, but we're going to pull back on that. But compare relative value analysis to fundamental analysis and charting. Then I'm going to give you an example from real estate, because real estate, it's pretty natural for us to do relative value analysis with real estate. And then I'll show you how to do it with stocks, which brings one of the exam questions. So what are the most common approaches to valuing securities? I'll give you a real estate example of relative value analysis, and then I'll talk about what good relative analysis works like. I stole some of this from Dr. Damodaran because this is his thing. He used to teach us classes doing exactly what you're doing in papers 3 and 4. And he'd ask the students, what are you going to do when you get out there? And he'd say, oh, we're going to be doing that. That's how we're going to do it. And then he decided to go out and ask them 5 years later, what are you actually doing? And he discovered that 0% of them were doing what you're doing in papers 3 and 4, and 100% of them were doing a relative value analysis. So he threw in the towel and started teaching relative value analysis. But he said, if you're going to do relative value analysis, you can at least do it correctly. And so he teaches, and he has a video out there that's really, really good. He has some papers out there that are all really, really good. So I did borrow still some of his analysis, because he does set it up really, really well. And the industry knows this. The things I'm going to show you here, the industry knows. They're real careful with how they do relative value analysis. So if you go in there and talk about sales, price to sales, they're going to say, what are you talking about, price to sales? That doesn't make sense. You talk about price to EBITDA, doesn't make sense. Why would you do that? So I'll talk about which relative you should use and which relative to use in which industry, because certain industries use different relatives, all right? And that is the essay question on the exam. It is kind of an essay question, but it's a pretty straightforward one. So what are the common approaches? There's 3 approaches. Fundamental analysis, maybe put that in your notes. That's your paper 3 and 4. So what is fundamental analysis? So this is why I so strongly recommend you listen to Business Breakdown. Are y'all listening to that podcast? I should start paying students to listen to that podcast. You really need to listen to it. I listened to one today and it was exceptional. It was on a company I knew nothing about, but I know their product. They sell Ray-Ban sunglasses and Oakleys, and They have lens crafters. Does that all sound familiar? Y'all know that was a non-US company. But very, very interesting firm. What does Business Breakdown do? Exactly what you need to do. Who is this company? What are their advantages? What's their sustainable competitive advantages? What's their value chain management? What did they do that other firms don't do? What did they do that do well that other firms could copy, and so it's not going to be there for them? What's their growth prospects? What market are they in? What's the growth prospects of their market? So like with this firm today that I can't remember the name of it because it's a European name that's got too many syllables in it. I don't know if y'all read out of COVID what happened in China, but China had this incredible lockdown where kids were being forced inside. What happens to your vision when you're forced inside all day long? Gives you terrible short-sightedness. And so China has a horrible sight problem right now with their kids, keeping them inside with no sun. Their eyes have really deteriorated, but they don't have the wealth to buy the product from this firm, but that's a huge market for them. Unfortunately, right, that is a huge market for them. So the economist was talking about it's pretty amazing numbers what President Xi did to the young people of China by forcing them to stay inside. That's a huge, I mean, we're talking 1 billion customers that haven't been tapped into at all. So that's the kind of thing you're looking at the fundamental analysis. What are you trying to do? You're trying to figure out the growth, just like you're going to do in paper 4, the growth. What's the growth here? So that's fundamental analysis. You're going to do discounted cash flow analysis, but you need a discount rate and a growth rate. That's where Business Breakdowns is, it's understanding these firms. Technical analysis is more what day traders do, or we did some technical analysis at UTSA, but technical analysis is really asking, can you bet on the stock based on patterns of stock prices? Are they breaking out of a pattern? Is there some kind of a corridor going on? Are they hitting a bottom? Did they overbuy or oversold? There's so many of them. If you're interested in that, you can just type the word tech in Bloomberg and they'll bring up every single tech there is out there. There's some good books out there on technical analysis. I believe in some of it. At the last CFA dinner, a woman spoke from Ned Davis Research. They're the best at this. I really like Ned Davis Research. They have some of the best charts and analysis. So that's technical analysis. That tends not to be the driving force, but there are some people that's all they do is technical analysis. But what we're going to talk about is relative value analysis. You can use all 3 of these at the asset class level. So you can look at large cap stocks and see, are they cheap or expensive? Where are they technically? Did the S&P break below its 200-day moving average? Those kind of things. And you can do relative analysis. What really works for the S&P 500 is a look at its PE ratio versus core inflation. There's a strong relationship with that. When core inflation is high, PE ratios are low, and core inflation is low, PE ratios are high. You can do that kind of regression and figure out the stock market looks expensive. Right now, it looks okay. It doesn't look cheap, definitely, but it doesn't look particularly expensive. So you can also do all 3 of these at the security level. Obviously, you can do fundamental analysis of an individual stock, but you can do fundamental analysis of an index, technical analysis. So these work for both assets and securities. So let's talk about relative value analysis. What we're doing here is you're taking something related to market value and related it to some fundamental factor. So the current measure of value to some fundamental factor, and those fundamental factors, there's many, 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 many of them. I'll give you the 3 most popular ones, but we'll look at them. There's 2 measures of value. What are the 2 measures of value? Anybody know? For relative value now? Do you remember it from 2013, Amelia? It's been like 3 years ago. I mentioned one, price to earnings. So what is that? Price. So what's the other one besides price to earnings? All right, so we'll learn that one. EV and enterprise value, that's the other one. So those, you only have 2 values, enterprise value and market value, price, okay? What fundamental factors? You have a bunch of them. We'll talk about that. There's earnings-based, revenue-based, and book value-based. So those are the 3 categories, but there's more. So let's look at this looking at real estate. But before we do that, again, here's the list. So I kind of forgot this slide was in there. So two measures of value, price, enterprise value. Enterprise value, we'll get into it, but enterprise value is market value plus the debt of the firm. So enterprise value includes the debt of the firm, right? Fundamental factors, there's a bunch of them, but they're usually earnings-based, revenue-based, and book value-based, but they don't have to be. I looked at Tesla, not using earnings, not using revenue, not using book value. I used it based on number of cars sold. And Tesla was by far the most expensive firm out there. Their market value versus how many, and even today with them having struggling, they're still a ridiculously expensive firm. I looked at Meta, at their earnings versus number of employees that they had. And Meta at that time was off the charts. Massive net income with very few employees. Now they had to add a bunch of employees because of all the, well, I guess they've gotten rid of them now after Trump got elected, but they had all those people, you know, doing misinformation and all that. So they had to hire a bunch of new employees. So it doesn't have to be these three. There are other things that you can do, but these are the most common. The question is, when do you use price and when you use enterprise? And then once you have price to earnings or enterprise value to revenue, which ratio do you use, which is industry? That's your question on the exam. There are industry specific ones, industries like real estate likes to use fund from operations, FFO. That's kind of their thing. Banks, well, we'll talk about some of these. So the relative value analysis doesn't really ask if markets are cheap or expensive, although you can do it at the asset class level, but it's really not asking if the stock market's expensive. It's really asking, is this stock expensive relative to everything else? So the whole market could be expensive, but if the whole market's expensive, do you want the most expensive ones or the least expensive ones? I'd rather have the least expensive ones. So coming into 2025, the market looked expensive and the MAGA 7 were the most expensive. If you had avoided them, you'd be doing much better today than if you'd had the MAGA 7. So we're looking on a relative basis. So within a market, they may be mispriced relative to each other. We use these terms. I don't know who came up with these terms. I don't like them, but we call them cheap and rich. And cheap is a good thing. It means it's inexpensive. I would have said inexpensive and expensive, but they called it cheap and rich. Cheap and rich sounds bad outside of anything other than relative value, but those are terms we picked. Remember I talked about interest rate spreads widening or narrowing. I don't know why we say widening, narrow, but those are the terms. So someone come up with cheap and rich, and that's what we use. All right, so let's look at real estate. So you're buying a house. It costs 150,000 bucks. That's all you know. You haven't seen the house, haven't visited it. You don't know what neighborhood it's in. Are you going to buy this house? 150 seems really cheap in this market, but is that enough information? I've had students say this about stocks, and it's always embarrassing when they do it in competitions. They say it's a $50 stock, so it's cheap. It has nothing to do. Or you have a stock that's $1,000. Wow, that's an expensive stock. Is that expensive? What could that stock do to make it not so expensive? Yeah, do a 5-to-1 split. Now it's a $200 stock. So it has, the cost tells you nothing. All right. So, you know, remember Berkshire Hathaway had what, the $100,000 stock? Is that an expensive stock? Well, it's expensive, so he keeps small investors out. But is it expensive? No, he just had very, 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 very few shares. All right. So that's not enough information. What if I tell you other houses in the neighborhood are trading for $875 and $675? So now we know we're in a pretty expensive neighborhood. So you know you're in an industry where you know stocks are trading expensive, except for this one's really cheap. What's the first question you would ask about this house? What's wrong with it? When you find a stock that's trading really cheap, what do you ask? What's wrong with it? So that's what we got to do is get that what's wrong with it. We got to bring in some factors that help us tell what's this stock doing that the others aren't doing. But this one's a little more interesting, isn't it? You might think I could buy this for 150,000 bucks, tear the house down, build a new house and sell it, you know, build it for 300,000 and sell it for 800. That may be interesting. But still not enough information. So let's bring some relatives in. And so the relative we use in real estate is price per square foot. That is a relative. It's kind of like, you know, just getting some sense of the size of the house, what the value of the company. We'll talk about Microsoft or Apple, what that per would be. But this house you can buy for $75 per square foot. Other houses in the neighborhood are going for $250 and $225. Price per square foot is a price relative. Do you buy it now? What's still your question? What's wrong with the house, right? Maybe it's in California and it's on the side of a cliff and they have mudslides and the house is probably going to go off the side of the cliff. There's things you could do. We actually had a neighborhood here in San Antonio was sliding down the hill. You probably wouldn't want to buy the house. But are you more interested now? It's starting to get a little more interesting. What if we could bring every single factor in that's interesting you and put that into a model and figure out the value of this house? Some of that would be related to value, what we call fundamentals. Some of that would be related to risk. And this is really important when you're running these regressions on the value of an asset, you got to make sure you have both value and risk. Because all you have is value, you might say, wow, that's really, really cheap, but it's really just really, really risky. If all you do is risk, you might say, wow, that's really low risk, but you might find there's just not much value there. Now, I don't know if I have the list. There's supposedly a model out there on real estate. I don't know if, oh, I just forgot the name of what's the Z company, Zillow? I don't know if Zillow has a model like this, but there are regression models out there on real estate that actually do a pretty good job of predicting housing prices. I already captured the size of the house, right, by doing square feet. Does it have a pool or not? Number of bedrooms? How nice is the kitchen? How old is the building? How good is the landscaping? Those kind of things. These are kind of things you look at on a risk side. Are you in a floodplain? When I sold my mom's house, they had a foundation problem. I thought, wow, that's gonna be disastrous. It was in Austin, so it almost didn't matter. Back then, all you had to do was say you're selling a house, and people say, "Oh, I'll give you 500,000 bucks." They didn't even look at it. It was a crazy market. But they had a foundation problem. Unfortunately, they had it fixed, and we had a warranty, and the firm that gave us the warranty was still in business. So I was able to give the warranty to the buyer, so they gave them some comfort. You know, I don't know what kind of things you would put on there on the risk side, but on the risk side could be important. You might be worried about they're going to build a new freeway in this area, or those kind of things that you're worried about. So you put all that in. I may not have all the things, but let's say I did have everything that was important to you. And you run a regression based on that regression that has a 91% R squared in predicting housing prices around in this neighborhood. This house should be going for $150 per square foot, and you can buy it for $75. If I had everything you cared about, would you buy this house without seeing it? Some people would, some people wouldn't. On the stock side, some people would actually use a computer to do all of their stock selections without doing any interviews of management, without looking at the firm. Other people is like, no, I've got to talk to management. I got to see the product. But there are people that this would be enough. Are you more tempted now than you were before? If this is everything you have, you might look at 4 or 5 other houses and see how they stack up, but it's looking pretty good. Let's say I add one more thing to it related to risk. And you ask, and this gets your R squared up to 98%. You ask, has anyone been murdered in the house? And is it considered haunted? And when you do that, the house value isn't 150, it's only 80. So now you know something bad's happened in this house. But you don't care about this. That doesn't bother you at all. So from your standpoint, the house is worth 150. But from the market standpoint, it's only worth 80. Now do you buy it? Well, it depends. Are you Warren Buffett or not? What does Warren Buffett say? I don't buy stocks, I buy businesses. He doesn't care what the market thinks. He's buying a business, he's going to hold it forever. What if you're going to sell this stock a year from now? Do you care about this? Absolutely, because this is going to influence the price of the house. Right? Are there houses out there that are haunted? There's a woman where I ride my bike in a Lotus. They invite me to their Christmas parties. And one of the neighbors was talking about her house being haunted. I think she was joking, but she wasn't. She was serious. So I fortunately didn't laugh too loud. She was a really good storyteller, so it was an interesting story. But yeah, there are places like that that could definitely be an issue. I wouldn't want something really famous to happen. Like, I've never heard of the Brady Bunch, but I wouldn't want to like buy the Brady Bunch house so people are driving by my house all day long taking pictures of it. So there are some things that would probably be irritating. So if it's a really, really famous event, yeah, maybe you wouldn't want that. So there may be some things to be interested. But that's kind of the key. You may think a stock is worth 150, but there's one factor the market's really focused in on that you don't think is important. Well, until the market gets over that issue, you're kind of stuck with that unless you're going to hold it for the long term and just it's an investment you're going to keep. So if you're going to live in this house until you get murdered in the house, then yeah, you can buy it for 75. You think it's 150, but if you have to resell it, you could probably only resell it for 80 per square foot. And so that's kind of the issue here is your horizon. So when we run these models in the investment society and the security analysis class, we do look at R squareds, and there are some factors that come in that we don't think are important. We might kick that out of our model and say, yeah, the market's focused on that, but we're not focused on that. There was one point in time a few years ago where the market was paying more for stocks that had companies that had more debt and paying less for companies that had less debt. We're like, that doesn't make sense. Debt is a problem for us. We don't want firms with high debt. For some reason, the market was paying more for firms with higher debt. You can kick that out of your model, but you have to just realize that if you do that, when you try to resell the stock, it may be an issue. Anybody know the word we use in finance for how do you justify that? So you need something. I would work this into your interviews. You know the word? I don't know how to spell it. Is that how you spell it? Catalyst? Is that right? You need a catalyst. So if you're focused on what you think is important, the market is not. How do you buy the stock, but when do you buy it? You have to know when is the market going to recognize what you see, and that's called a catalyst. You might say, wow, this is a great company, great product, but it has terrible management. As soon as they replace management, this stock is going to zoom. Well, what if the CEO's been there for 20 years and his son's probably going to take his place? Yeah, you're kind of stuck. I remember I had a really good speaker in my security analysis class, a guy named Jason. I may ask him to come back this next semester. But he was buying Apple, and his whole argument was Apple is cheap because everybody this is back several years ago. Everybody was expecting Apple's margins to shrink. And they had good arguments because what Sony was doing, some others. And so home markets thinking, and he had a strong argument that the margins would not shrink. And it was a really, really good argument. Well, what was his catalyst? Well, his catalyst was Apple just need to report earnings 2 more quarters and show that their margins were staying stable and even expanding. It was going to be pretty quick for the market to figure out what he was saying. So not only did he have a good valuation, he understood the company really well, but he also understood when the market was going to come around to his side. And it wasn't going to be 6 years from now, it's going to be 6 months from now. That's what you need. So if you disagree with the market, you've got to figure out how long will it take for the market to come back. If the house is haunted and someone's been murdered in it, that may be still impacting people 10, 20 years from now. So you better stay with the house forever. So a catalyst is real important. Catalysts need to have a timeline to them. When will the market come around to your view? So a cheap stock that's cheap for a reason, and you understand that reason, also needs to be something that the market's going to understand your reasoning within some reasonable period of time, right? So that's the real estate example. It ignores whether the housing market's overvalued or undervalued. There's no question in my mind that Austin real estate was overvalued, and the values have come down some. I just need to get my mom's house sold. That's all I cared about. I was kind of happy. That ended up being her retirement plan, selling a house so expensively. So I thought the market was overvalued, but it didn't matter. I needed to sell the house. So I was just lucky. So is the house I'm buying reasonable given what other houses are going for? Once I adjust for those key differences, that's exactly what we're doing with stocks. Is this stock price reasonable once I adjust for all the things I care about? We'll talk about the things that we care about. So for our price relative to work, first it's got to be appropriate to the industry, but you got to adjust for fundamentals. You got to adjust for risk. You can do things that are generic for all industries, but the more specific you can get to your industry, the better. Some industries work really well. Airlines work really, really well. If you build a model, there's maybe 13, 14 airlines that are publicly traded around the world. You probably have to bring Ryanair in and some others. You'll get a really good model. And you're probably not going to find too many mispriced securities because it's pretty straightforward how they value these industries. And you'll be using very industry specific ratios. Banking, very, very generic. I mean, very generic things you can do, but in banking, you get really specific. Net interest margins, charge-off ratios, capital ratios. There's very specific things to banking. There are some industries like retail where you can probably use the exact same factors for retail discretionary as you use for retail staples. Consumer staples, consumers, they're very generic factors. They work for both pretty easily. I load up retail heavily on working capital because that's really important to me. I wouldn't use working capital for banks or insurance companies because it doesn't mean anything for them. That's one thing we're going to be doing in secure analysis. In the fall semester, we're taking the easier industries. In the spring semester, we're going to come back and we're going to tackle some of those hard industries like banking, like insurance, like energy, that are just really, really tough industries. This is, if you're going to be an analyst, this is where you make your 7-digit salary, is you understand those industries so well, you know exactly what factors, not only do you know the factors, you know what a good one is, what a mediocre one is, what a bad one is at any time, you know where they are relative. This is where you earn your keep. If you start on the investment banking side, which is the sell side, you may only be covering 10 companies. You're going to know them extremely well. So it's incredible. To me, it's exciting. You start off your career, you feel so stupid because you don't know anything. And then 3 years later, you know all this stuff. To me, it's a really exciting part of your life because like learning curve, it's scary. It scared me to death. I don't think I ever took a new job that I wasn't scared to death at until the very last one. The very last one, I was like, I don't know what I'm doing, but I know I'll figure it out. But the first few is like, man, you know, that fear of I might be in over my head. You like question yourself and you just go for it, jump into it. And that's what you got to do with these industries. You're going to be hearing terms. I remember when I started with life insurance, I was like hearing these terms like, I have no idea what that is. They didn't teach us that undergraduate. What's a deferred premium? What do you mean deferred premium? We didn't use deferred and we used premium undergraduate. Now I got to use deferred premium. But I learned it. I talked to the actuaries. They taught me. I learned it pretty quickly. Yeah, you sit there 50 hours a week, you're going to learn it. So that's where you earn your keep. So that's why the more complicated the job, the better, because you're learning stuff that they're going to pay you a lot for. And that's where it comes from in those really specialized areas. So the things that have to be present, you have to have the appropriate price relative. Appropriate in that it's correct. It's not an error, and it has to be right for the right industry. You have to have some measure of fundamentals, whether it's generic or industry specific, and some measure of risk, whether it's generic and industry specific. On the risk side, there's one thing Bloomberg has done for us that is really, really, really nice, is they have a factor called the probability of default. It's they have a 1 year, 3 year, 5 year, but I love their 5 year probability of default. Can be an all one-stop place to go for your risk. Works really, really well. Works for all industries. It's quite exceptional. So the reason I like it is it covers everything you would. It covers your debt, covers your the volatility of your earnings, any type of accounting problems. It covers all of that stuff in one ratio. So it's kind of nice. But there are other ratios we can use. Fundamentals is really where you want to add more things. I've had students on the banking side. I have one student, he went in just every single factor that is in existence for banking, he brought it in. So he had like 50 factors. He just went overboard and said, tell me which of these factors are important. So what you're trying to do is take the fundamental factors and the risk factors and forecast the relative value factors. Given these fundamentals, given these risks, what should their PE ratio be? And you'll compare that to their actual PE ratio and you'll make a decision about buying or selling. If they have better fundamentals, they should have higher relatives. If they have higher risk, they should have lower relatives. All right. So what's a good fundamental factor? Well, growth. Firms that are growing fast should be more expensive than firms that aren't growing fast. What's a good risk factors? Debt. Firms with high debt should be cheaper than firms with low debt. Okay. but debt is very industry specific. A debt ratio for utility would look insane for a technology company. A lot of tech companies have almost no debt. Utilities are just overloaded with debt. So you have to look at it industry specific. All right, so this formula should look really familiar. I love this page. I've memorized this page. You already know this first one, the value of a stock is the dividend divided by the discount rate minus growth. You all remember that? So I can break this out in more pieces. What is the dividend? The dividend is the earnings per share times payout. Right? That's what the payout ratio is. You might use that in paper 4 for your growth rate. That's dividends. What's your discount rate? Your risk-free rate plus beta times the market risk premium. We just did that minus your growth rate. So what is your PE ratio? How do we get a PE ratio out of this? Why don't we just divide both sides by earnings? What does that tell you? Your PE ratio equals your payout divided by your risk-free rate plus beta times market risk premium minus growth. There's so much right there. Now, Dr. Demoterin, he does the other relative, the EV to sales and the price to book the same way. It gets really complicated when you do that. But this is basically here. So what is this telling you? Well, there's 2 factors in here that are stock market wide. They don't apply to your company, apply to everybody. The risk-free rate applies to all companies equally, and the market risk premium applies to all companies equally. So when are PE ratios low? When interest rates are high, right? If I increase interest rates, what happens to my PE ratio? If I increase the denominator, PE ratio is going to fall. Today, PE ratios are around 20. Interest rates are relatively low. In 1980, interest rates were really high. PE ratios were like 8 or 9. So when interest rates are high, PE ratios are really low. Interest rates low, PE ratios are really high. The relationship's actually stronger to inflation than the interest rates, but it works. Market risk premiums. How can you measure the market risk premium? Y'all know the factor for that? What's a good proxy for a market risk premium? Any guesses? Yeah, have y'all heard of VIX? We talked about VIX. So that's the volatility index. When the VIX is high, market risk premium is probably high. You saw the VIX. This is the Trump VIX. It's still pretty high. Normally the VIX is about 18. Today it's at 33, so it's almost twice. It got above 50 not too long ago. That's when the stock market almost hit its all-time low. So when risk is high, PE ratios will be low because stock markets were selling off. So when interest rates are high, you should have low PE ratio. When risk are high, like in 2008, stocks get really, really cheap, right? That's the overall market. Then to your company, you have 2 things related to your company. You have fundamentals and you have risk. Notice we're subtracting growth. Growth is a fundamental. So if you're subtracting growth, if growth is high, what will PE ratios be? They're going to be high. There is a direct relationship because you're subtracting growth. So firms with high growth should have high PE ratios. Firms with low growth should have low PE ratios. What about beta? That's additive. Betas are high. What should PE ratios be? They should be low. So high risk companies should have low PE ratios. Low risk companies should have high PE ratios. Let's look at this. These are old numbers, right? Tesla has really killed this. But Tesla, very, very expensive. Is Tesla very, very expensive because it's a low risk company or because it's a high growth company? What would you say? Probably high growth because this should be a high beta company, right? It should be a high risk company, but it's still high growth. Kroger's beta is really low. Is it really low because it's a high risk company or because it's a low growth company? Low growth, right? So you would expect Kroger to be what? Expensive because it should be low risk, but there's something going on with Kroger's. Walmart, is it Walmart high beta because it's high growth or because it's, is it high PE ratio because it's high growth or because it's low beta? Low beta. Walmart looks expensive, but it's really not expensive because it's a very low beta company. So it could be that Tesla's just expensive. It could be that Tesla is high growth, or it could be that Tesla's low risk. It's probably a bit of being expensive and being high growth. Kroger's could be low beta because it's cheap, but probably not because it's high risk. So but Kroger is either a cheap stock or it's a low growth stock. So that's what PE ratios are showing you. These are old numbers. If you go in today, obviously Tesla got really high there not too long ago. Their PE ratio is 110. So it's come down quite a bit. Now, does that mean the stock price fell or did its earnings grow? And it's probably a combination of the two, but definitely, my word, what happened today? That's pretty interesting. Sometimes those are just erroneous trades that come in. Kroger has corrected itself somewhat. So its PE ratio is back up to 19, about to 20. It's kind of an average, so it's probably low growth, but low risk. So it's kind of in there in between. Walmart was really expensive, but boy, Walmart has come off. Why is Walmart selling off so much? Tariffs, yeah, they get everything from China, but their PE ratio is still ridiculously high. Imagine how high it was back up there. Extremely high PE ratio. I think it's an expensive stock. Could Walmart be a high growth company? I can't see it. I can almost throw a tennis ball at two Walmarts and hit both of them from where I live. There's just so many of them out there. They tend to, anywhere HEB puts a store up, you'll see a Walmart there within the next 6 months. So the PE ratio is telling you something about the company. You got to decide what it's telling you. It's either cheap or rich, high growth or low growth, high risk or low risk, and are a combination of those, all of those things. So our numerators are going to be either price or enterprise value. So when do you use price? You use price when your denominator is after interest expense. Pretty straightforward. Why? Because price belongs only to the stockholders. So you want to get the debt holders out of there. So anything that's net of interest, net of debt, you use price. When you use enterprise value, stockholders and bondholders, anything that is before interest. What is the BI here? BI here. Before interest. See, I've heard students say earnings before income tax. So that's not what it is. Earnings before interest and taxes. So what would you use here? Enterprise value, because it's before interest. Anything that's before interest expense, you use enterprise value. Earnings per share, you use price, because that's net income after interest expense. What about EBITDA? What would you use? Enterprise value is before interest. All right. Book value. Book value of the firm. That's their assets minus liabilities. Is that stockholders or stockholders and debt holders? When you subtract liabilities, what are you subtracting? The debt holders. So what do you use? Is it price to book or enterprise value to book? It's going to be price to book because there's no debt holders in there. All right. Revenue. Is revenue before interest expense or after interest expense? Before. So what do you use? Enterprise value. Yahoo Finance has it right with one exception. So they got PE ratio, they do trailing and forward, they do price to book, they do EV to revenue, you do EV to EBITDA. What's the one they have wrong? You don't use price to sales. That one's completely erroneous. All right, why they have that in there, I don't know, but they do. All right. We'll talk about the PEG ratio some. It's actually, we have our portfolio is a PEG ratio portfolio. It's still doing pretty well. So that's one of the questions on the exam. If I give you price to revenue on the exam, you got to kick it out and say that's wrong because price is stockholders, revenue is stockholders and bondholders. If I give you enterprise value to book value, say that's wrong. Enterprise value to both stockholders and bondholders, book value is only stockholders. All right. So you're going to kick some of them out. We'll see that. We'll do that question next week as a practice. So it's critical that your capital providers are lined up, the numerator and the denominator. Right, just like what I said. So what are your choices? On the earnings based one is price to earnings, EV to EBIT, EV to EBITDA, and then the PEG ratio. I'll talk about the PEG ratio in a second. Now, what's the most popular one? According to Motorin, the most popular is EV to EBITDA, and he thinks it's because people just like saying EV to EBITDA because it sounds cool. There's another reason that I think he talks about as well, but I think is also important. What's going to be the highest number of these three? Well, it's probably going to be price. Why? Because you're dividing by earnings. Here, you're dividing by a number where you're adding back a bunch of stuff. So your denominator is going to be much larger. It's going to give you a much smaller number. And most people like to say, hey, this stock's trading at 12 versus saying it's trading at 20. Even though the two numbers are exactly the same. Its PE ratio is 20, but its EV to EBITDA is 12. You say, wow, 12 sounds like a lower number. You're probably gonna get your boss to buy the stock if you use the 12, even though it's fictitious. So we look at this company, their PE ratio is 38, but the EV to EBITDA is only 19. They're really the same because we're adding all that stuff back for EBITDA. But you'd rather tell your boss, yeah, it's trading at 19. That sounds cheap. 19 is actually really expensive for EV to EBITDA. But when you say 19, most people are thinking price to earnings. So that they kind of distort the number. EV, the revenue is going to be the smallest, obviously, because revenue is going to be the biggest number. So those are earnings based. What is PEG ratio? PEG ratio is your PE ratio. Now, we talked about this earlier, right, in previous class. So your PE ratio divided by the expected growth over the next 5 years. And there we use the forward PE. And you can see 5 years expected growth. So it's just that forward PE ratio divided by, and that's how you're getting the growth rate. You can just use those ratios and you can figure out what the market thinks growth rate is going to be over the next 5 years. Most people think a PEG ratio, or it used to be a PEG ratio below 1 is a good stock. NVIDIA might be in that position below 1. They're right around 1. So NVIDIA actually looks cheaper than Walmart on a PEG ratio standpoint. Even though their PE, well, even their PE ratio, I mean, that's pretty amazing, right? NVIDIA's PE ratio is lower than Walmart's, and their PEG ratio is much lower than Walmart's. It makes you think Walmart looks really, really expensive right now. But we could put Costco in there. And look at Costco's PE ratio, 58. And their PEG ratio is 6. Costco, I love Costco. I hope it sells off dramatically one of these days so I actually buy the stock. It just looks way too expensive to me. I don't know why anybody would spend that much for a Costco, but it's a great company. That's probably why people love it. It's a really, really good company. Your book value relatives are price to book, or what you can do is kind of a quasi price to book is do price, but to like 10 years of earnings. And that works really well with really cyclical firms. There's a famous, it's called the CAPE ratio. Robert Shiller did it, where he looks at the US stock market price to 10 years of earnings, adjusted for inflation. It's a really good ratio. You can actually get it out there. I think I showed it to you all earlier in the semester. So those are kind of two similar ones. Right now, price to book is a little tough, because if we look at McDonald's, what's McDonald's price to book? It's dashes. Why is McDonald's price to book dashes? Didn't I show you all that earlier? What's McDonald's net worth? It's a negative number. You can't do a price to book. So, but you want to, well, I wouldn't use price to book for McDonald's, but if you wanted to, like Boeing, I would use price to book for Boeing, but their net worth is negative. Well, if they don't have a positive price to book, you can substitute 10 years of earnings, get a positive number. You get a very similar type of analysis. So sometimes that price to 10 years of earnings is a substitute for price to book because book value is negative. And then the last one is revenue base is EV to sales, enterprise value to sales, right? Okay, we got just enough time. Let me give you the final version here. And I may show you some models next class. So when do you use earnings base? Usually firms that are focused on revenue earnings growth, usually technology. Technology, they love to use EV to EBITDA. It's the most popular one. Really, really common to use EV to EBITDA. Because we love saying it, because it gives you the lowest number. Book value relatives are used for 3 types of industries. High capital requirements, like utilities and manufacturing. You can tell you should use a price to book if you go on their balance sheet and their property, plant, and equipment is like 50, 60% of their assets. So firms with a lot of property, plant, and equipment, you almost always use price to book. It's used for cyclical companies like energy and materials, because if you don't use price to earnings, they look really cheap when oil price, like Exxon looks really cheap when oil prices are high. they look really expensive, oil prices are low. Because the market knows oil prices can go up and down, so they don't have the price going up and down. So oil prices are high, it doesn't look as expensive because the market doesn't extrapolate that out into the future. So if you use price to book or price to 10 years of earnings, you take that cyclicality out and you can look at the stock. So Valero and Exxon, some gold producing companies, steel producing company, I would use a price to book. And then the last one are those entities focused on return on invested capital. Everything that's financial services, banks, insurance companies, real estate, use price to book. So if I'm doing JP Morgan, I would do price to book. If I were doing Exxon, I do price to book. If I were doing Intel, which is a technology company, I use price to book because they have massive property, plant, and equipment. So I like on this top one, I just look at their property, plant, and equipment as percentage of assets. If that's a high ratio, I would use it. So Intel's a semiconductor firm, NVIDIA is a semiconductor firm. You can really contrast them. So you look at Intel, look at their assets. Their property, plant, and equipment is over 50% of their assets. But you look at NVIDIA, their property, plant, and equipment is not even 10% of their assets. Why? Because Intel has these massive fabrication plants. NVIDIA develops chips and then does what? They send them to whom? TSMC, right, over in Taiwan. They don't actually produce the chips. They send them overseas. ASML, I don't know what their ticker is. Is that them? Must not be. It must have their own company. But some firms just have, even though they're tech firms, they just have massive, massive property, plant, and equipment. You probably want to use price to book. And then revenue base, anything retail. So consumer discretionary, consumer staples, use retail. So Costco, Walmart, Target, you use EV to sales, would be the most logical thing. Now, one thing I've noticed when we run our models, with retail, it always picks EV to revenue, but we discovered with tech companies, for sometimes tech companies, the model will actually use EV to revenue. Doesn't make sense to me. We'll often switch it to EV to EBITDA. One wonderful thing about EV to revenue is you don't get NAs. Because if book value or EBITDA is a negative number, you can't get a ratio. But you always get a ratio with EV to revenue. So it does have the advantage that you don't get these NAs and you can run your model much more easily. So, all right. So next class, I'm going to show you some models that we've actually built. If I remember to bring them in, and can show you, I can pull them up from here. I encourage you to build one of these models yourself. I have videos on my Bloomberg channel that you can use to build models in using Bloomberg. I encourage you to do that. We'll be doing that a lot next semester with the secure analysis class as well. All right, I'll stop it there. Gordon growth, dividend discount model is just the value equals dividend 0 times 1 plus growth divided by KE minus growth. So here the dividend is 444, the growth is 1.04. The discount rate is 7.8 minus 4%, 121 bucks. And then the H model, is the exact same thing, except for we have this extra growth period we're going to do. Dividend 0 times H times growth short term minus growth long term divided by growth KE minus growth long term. So it's the exact same formula. So we do the exact same thing again, but here we add in plus 444. How long was the H? It's 2 because it's 4 years. You take that in half. And then what was the short-term growth rate? 10%. 0.1 minus 0.04. You get 135. So yeah, very, very straightforward. I think I put this file out there on Canvas today. We got just about everything in it. It's really messy though. If I remember, I'll try to remember. All right. We only have maybe 2 more team questions to go. So, and then I'll work a mock exam. All right. So we were talking about relative value last class. So just to show you a model, we'll be using these models in my secure analysis class. We're going to use them in the investment society. I'll show you this model. So what I did here is I brought in all the consumer discretionary stocks in the Russell 3000. There's about 250 companies in here from all different sectors and industries. Here's the companies. Some of you know, like General Motors. Some of you probably never heard of, like Jill. Have y'all heard of Jill before? No telling what Jill does. It's apparel, retail, some really small companies, some larger companies. Poultry, you probably heard of them, housing. Sometimes you get a company that's in there twice, so we can delete the extra company because they have extra shares of stock. Here's DH Horton, so you get some Expedia. I use them all the time. eBay, I haven't used eBay ever. Hotel, Lululemon, y'all probably heard of them. Royal Caribbean. Darden, have y'all eaten at Darden? What does Darden own? Olive Garden. Red Lobster. Is Red Lobster still in business or are they shut down completely? Olive Garden's their biggest one. There's Amazon, obviously, huge one. O'Reilly, AutoZone. So McDonald's is in there. Six Flags is in there. I don't know that group. Copang, y'all know them? Broadline, I don't know who that is. I got to look that one up. Who is Copang? What a terrible name for a company. Oh, my word. E-commerce platform. Why is that in the Russell? I don't know why that's in the Russell 3000 because it doesn't look like it's a US company, but the exporting Tractor Supply Company, Texas Roadhouse, which I saw was like the most popular restaurant. I don't know if it was in the US or in Texas. Chipotle, I have eaten at Chipotle a couple of times. Ross is a great store, really interesting. I don't know why Ross is in here. Do y'all consider Ross consumer discretionary or consumer staple? Is Ross a high beta or low beta? It's apparel, so kind of high beta, but Ross is cheap clothes, right? Huh? Discount clothes. So I would make them, maybe close to one, but not too much. Nike, TJX. Now TJX is another one, right? TJX and Ross secondhand clothes kind of stuff. Home Depot's in there. That makes sense. So a lot of companies that you've heard of. So I brought in their market cap to get a sense of the company, but that's not in my model. And then what I do with a model is I measure. So you want to, in an interview, you want to say, I have a multi-factor stock screening model. And it even sounds better if you just add the word proprietary. You can spell it. So in an interview, you want to say, yeah, I've built a proprietary multi-factor stock screening model. That's what this thing is here. If you take my security analysis class, we build them in that class. Or you can teach yourself because on my YouTube channel shows you how to build them. What does proprietary mean? It's just an unnecessary word. It just means that you built it. Multi-factor, how many factors do you need for it to be multi-factor? At least 2. So that's pretty straightforward. I have 15, so I got that covered. It's a stock screening model. If you're interviewing with HR, that's probably going to sound pretty impressive, right? They're going to be, wow, you're really advanced. It can be pretty basic and pretty simple. What is CAPM? CAPM is William Sharp's single factor model. So you get multi-factor and single factor. So here's a model, and the way I break it up, my factors. Remember, you need factors related to fundamentals and factors related to risk. So my factors are broken up into turnover, margin, return on capital, and then risk. So I have those 4 categories. For turnover, I start off with just revenue growth. Revenue growth is a great one. I do actual asset turnover. You remember asset turnover from 3013, revenue divided by assets, higher is better. I also do ATO expansion. So not just how high is their ATO, but is it improving or is it getting worse? Working capital is a big part of turnover. How well do they manage their receivables and inventory? This is where the accountants get it all wrong. If you ever learn ratios like the quick ratio, the current ratio, just the acid test ratio, just throw them out. No one in finance. The only place you see those is in accounting classes and in college classes. But in commercial banking, they use them. But in real life, we don't use those ratios. Those ratios say inventories and receivables are good things. Finance says no, receivables and inventories are a terrible thing. We want those as low as possible. So we're looking at working capital management. Then we get into margins. We look at gross margins. We look at the growth and EBITDA relative to sales. So are their earnings growing faster than sales? That's a margin issue. And then the EBITDA margin, and then I look at EBITDA margin expansion. So there's my margin items. And then I look at return on capital. I do an actual ATO times margin, which is essentially return on assets. I'll look at EVA. EVA is essentially return on capital minus cost of capital. I like that one. And then I look at their EVA, is it getting stronger or getting worse? And then on risk, I have 4 things on risk. A couple of them probably don't matter, but this Bloomberg function, 5-year probability of default, it can be your all-in-one risk factor if you want to. But I do bring in debt to EBITDA. I'll bring in the 90-day volatility. Doesn't really work with consumer stocks, but it works really well with tech stocks. How volatile has their stock been? I bring in the short interest ratio. It's not that big of a deal, but with what happened with the meme stocks, with GameStop and some of those others, I'm just kind of curious to see if there's something there. And then I compare all of those versus valuation. So I'm thinking firms that have good turnover, good margins, good return on capital, and low risk should have high valuations. The 2 valuations I brought in were EV to EBITDA. Remember, if it's EBITDA, it's before interest, so you use EV, you don't use price. And then I use EV to sales because sales is before interest expense, so you use EV. For consumer stocks, the model's almost always going to use EV to sales, but I bring the 2 in there just to see. And then all I do is I take all of those factors and I rank them. So this firm ranks 135th on sales growth. They work 93rd on their earnings versus their revenue growth. They really don't rank very well at all anywhere. But I'm going to take all of these factors and I'm going to create a rated rank. I've got 15 factors. So let me start off by putting 1/15th into each one of those. When I do that, that adds up. Oops, I missed one. When I do that, that adds up to 100%. And then I have 2 valuation ones. I'll just do 50% each one of those. All right. And then I'm going to do a weighted rankings. So 7% times the rank on the first one plus 7% on the rank on the second one. What function can you use in Excel to do that? That's what sum product does. Sum product takes the 7% times the rank all the way across. I do the same thing on valuation, 50% on EV to EBITDA and 50% to sales. I then re-rank them because the only way a firm can be number 1 is if they rank number 1 all the way across. That's not going to happen. So what I do is I re-rank it. Do we have a number 1 firm? Let's see. In the past, Monster's always been our number 1 firm. Let's see who it is now. No, look at that. Lululemon is our number 1 firm. They didn't rank number one on everything, but they ranked really well on everything. 31st on sales. You can see they didn't do too well on capital management. They did really well on the return on assets. Pretty good debt. In fact, Lululemon really doesn't have debt, so that's why they score so well on that. Their stock's a little volatile, but now when I do that, I get a correlation of 0.32 or an R squared of 10%. That's pretty pathetic. How can I improve that? Well, I can improve it by telling the model to change these ranks to increase my correlation. And what function could I do? Use that. So I need solver. Do y'all use solver? How many of y'all use solver? Some of y'all, I use it all the time. I think it's amazing. So let me add solver in here. Let me take it a second to add. So what I'm going to do with solver, I'm going to tell solver, maximize the correlation by changing, I don't know why I didn't give me my functions, by changing these weights. I'm going to have two constraints. My weights on the fundamentals need to add up to 100%. And my weights on the valuations need to add up to 100%. And then I'll tell Bill Gates, do whatever it is you're doing. Let me fix it one more time. My objective function. Oh, I didn't do my objective function. That's the first time I've ever seen solver. Oh, it's because maybe it's because I'm doing it in the where I have values. All right, that should work. So Bill Gates will do whatever he does. And that brought our correlation up to 0.85, which gives you an R squared of 72%. You remember that? That means the volatility of my ranking versus the volatility of the valuation ranking. My ranking can explain 72% of the volatility of the market. So here I have my fundamentals, and here I have valuation. And difference tells me how far something is from my valuation. So a good example is this stock right here. I don't know this company. Oh, it's education. Well, wait, let me find a better one. That one's pretty pathetic. Let's try this one. Monarch. I don't know. That's a casino. We rank it second, but it's the 51st most expensive. So it gives us a difference of 49. That might be a stock we want to purchase. I don't know what Monarch does. I don't know what its city. Well, it's probably not in it's probably in Vegas or someplace or Nevada. It's a casino and a resort. But my model really, really loves it. It's the second best one out there, and it's pretty cheap. Sometimes what I do for my buy and sell list is my criteria is I want them ranked in the top 25%, and I want the difference to be at least 25, something like that. So like this firm here, the difference is huge. It's 97, but it's ranked pretty low. It's just that it's really, really cheap. So I might say, hey, I'd rather have this firm, Abercrombie. Have y'all bought anything from Abercrombie in your life? Have you? From their store or online or what? Well, okay. I would never go into one. That would be so out of place. They're like, you're like 50 years way too old to walk in here. But anyway, our model likes it. It's in the top 51 out of 200 and something, and it's pretty inexpensive stock. This is an education company. I don't like the education companies. I think they're under a lot of pressure to generate degrees without doing much teaching, and their students are having a tough time getting jobs. So I'm somewhat avoiding them. Here's Crocs. When's the last time you bought something from Crocs? But they're ranked 12th, and they're really inexpensive. Then you go to the other extreme. You got a firm like this we rank 85th, Duolingo, but it's the most expensive. Now Duolingo just came out with some great news today. That may be why it's an interesting firm. I like it, but my model says they're not there yet. So it wouldn't like it. It's just a very expensive firm. I don't know if Monster is in here. Yeah, and my model might have had to kick it out. So that's what we're looking at. And you can actually graph it. What you do, you're graphing it based on your ranking. I mean, based on the valuation ranking versus your ranking. So a firm right down here is very well valued. You love it, but the stock market also loves it. This firm right here, you love it because you rank it really low, but the stock market doesn't. So that would be on your buy list. You rank it 15th, but it's the 99th most expensive one. Here's another good stock right here. You rank it number 4, but it's the 60th most expensive. So your buy list would probably be these firms right in here. Now this firm is ranked 152nd out of 249, so it's cheap, but it's not a very good company. So I kind of like high quality companies that are cheap versus low quality companies that are cheap. These down here are the horrible stocks. This one's really, really bad. You rank it 178th and it's the 79th most expensive. So you get this to be your buy list. And once you have your buy list, you then do much deeper research into each one of those. That's what we'll do in the fall. We're going to do it in the Investment Society and in my security analysis class. We'll get that buy list, and then we're gonna use all kinds of models to get from that buy list to get down to our actual recommendation, which is very similar to what you're doing in papers 3 and 4. But in papers 3 and 4, you're only looking at one company. What we have to do in the fall is we have to try to look at 5 or 6 companies and come down. So we have to you built that template, right, for papers 3 and 4 to the evaluation. You get that built, and then you just update it for another company. You could probably do other companies pretty quickly now once you have that built and you just update it. So this is how we can use relative value analysis to very quickly give us a list of stocks to assess and analyze. So I like it. It's a good approach. I do it in Bloomberg. It won't work on this machine because I don't have Bloomberg loaded, but Bloomberg automatically dumps all this material in, all this information in just like that. I then copy and paste it as value so I can use it from a computer at home. So this model works from home. So it works really well. If you want to build something like this, go to my YouTube channel, look for Bloomberg and teach yourself. The aerospace is probably the best one because it's fairly straightforward, fairly simple to use. I like this one because it's got everything I want and it's already built. So I don't have to spend a lot of time rebuilding it. But there are other things that you can do. One thing to look at the end here is the weights that were used. It puts 17% on revenue growth, 10% on capital management, 14% on gross margin, 41% on net margin, and it put 18% on risk. I've got something in every category except for return on capital. So what I could do is I could tell the model, make sure you have at least 10% in each one of those 4 categories. And I could rerun it. Obviously, my R squared would come down because I'm forcing it. So I could do that. I could tell solver. Well, let me just a second. So here's each of my categories: turnover, margin, return on capital, and risk. I could take each one of those. So here's my turnover. You'd expect with consumer stocks that margin would be the biggest category. But you would want something on return on capital. So we could rerun the model and tell the model, hey, I'm going to add another constraint. And I want, well, one last thing. Where did I put that? Over here. I could do equal min of these. And then I could tell solver, add a constraint. I want this minimum to be greater than or equal to 10%. I want each category to have at least 10% in it. And when I hit solve, obviously my correlation is going to come down, but it didn't come down terribly. And at least now I have something on return on capital. It put 5% and or 2% and I don't know how we got 10% there. Misdo my. Oh, yeah, I got too many categories here. Let me run it again. It brought it down a little bit, but not much. So now I have 10% and on return on capital, and it kind of spread it between the 3 things. So there's all kinds of constraints you can put in there. You may still not like this model. You might tell it, hey, I got to have at least 5% in this or whatever. You can decide how you want to put the categories. Every time you constrain it, it's going to bring your R squared down and your graph won't look quite so tight. I've had some students with an R squared of like 99%, and I know they did something wrong. And what they'll do that really messes it up is they will put a price factor in their fundamentals. And you can't do that. You can't have the model try to use price to predict price. So you can get a really, really high R squared. I remember William did that once. He was so excited. Hey, professor, I got a 99 R squared. I looked at, yeah, you got price predicting price. And everything's loaded in that one thing. So you can't use PE to try to predict EV to EBITDA. They're so highly correlated. So you don't want anything related to price in your fundamentals because that's what you're trying to predict. But here's a decent model. My recommendation is you be able to build one of these from scratch from step one without any notes, just off the top of your head, build the entire thing. That's your goal. And the secure analysis class will probably be able to do that because they have 3 rounds, so they have to do it 3 times. So hopefully by the 3rd time they would have got it or paying attention. All right, any questions on that? Could you do this in real life job? Yeah, if I were starting my job as an analyst, this is probably what I would do. And they wouldn't look at me funny. You would be in good shape. Probably 80% of college undergraduate students wouldn't have a clue where to start. So if you can build this, you don't know how to do it now because I did everything. But if you can build this yourself on your own, you could start a job and have pretty good sense of how to get going. These are my factors. I don't know what other factors you use, but that's the main thing the market is looking at. All right. Let's talk portfolio management. This is something else you want to be working on before you interview for jobs. It's one of those things that you may not have a belief, but you need to pretend like you do so you have something to talk about. So just pick something and go with it. I'll show you some strategies you can just copy. So you want to build a portfolio. How much do you need? Stock portfolios, if you can buy individual securities, I think you really need at least $100,000. If you can buy ETFs, that you can do with a lot less money. It's a lot easier, but individual stocks, we're looking at Netflix today. Netflix is trading for $1,000. So the minimum allocation you make to Netflix is 1% of your $100,000 portfolio. You're kind of stuck. You can't do 0.5%, something like that. So some stocks are just trading so expensively. But so if you have less than 100,000, 150 is maybe a little much. Maybe 50,000 you could, but once you get down into $3,000, $4,000, $5,000 range, you're probably just going to buy an ETF or a mutual fund. You can get pretty fancy with ETFs with $5,000 because you can buy several of those and do some asset allocation. But individual stocks, you need more. Bonds, I don't think with bonds you should buy individual bonds. Corporate bonds, you can buy treasuries. Treasuries are a piece of cake. I buy treasuries all the time. But corporate bonds, I would not buy them if you didn't have at least a $15 million portfolio because you really get ripped off on the bid ask. It's not a retail market. And I include that for municipal bonds. With municipal bonds, you really get ripped off. A lot of semi-wealthy people with $1 million or so buy municipal bonds, and boy, they're getting ripped off. They'd be much better off buying a mutual fund. So when you're buying a stock, this is the question I always ask in interviews. What is a good company and what is a good stock? When I ask undergraduate students that question, I get blank stares. If I go UT Austin, they talk about teams and how important teams are. I don't know why they're bringing up teams. Someone has told them you always got to use the word team 20 times in an interview. But most undergraduate students have no clue how to answer this question. I asked someone who's been doing this for 5 or 10 years, and they pull out a stack of paper that high, and they can't wait to tell me how they do it. So what do you mean by a good company? Well, I just showed you. Good turnover, good margins, good return on capital, low risk. That's what a good company is. What's a good stock? It's one that's not expensive. So a good company has good fundamentals. A good stock is not expensive. That's exactly what I just showed you, isn't it? That whole model. You need to have a definition of what a good company is. This is why I so strongly recommend you listen to Business Breakdown. Have any of y'all started listening to it yet? Have you, Anthony? I mean, it's really, really, really good. I listened to Ecolab today, which is one of my favorite companies. It's just an expensive stock, but it's a really great company. And then they did a Compass. I'm not that familiar with Compass, but really interesting company as well. Those are good companies. But if you listen to Business Breakdown, they tell you how you know it's a good company. They ask all the right kind of questions. Probably the most important thing you're going to ask is sustainable competitive advantage. What did they do that makes them better everybody else that everybody else can't copy? That's probably the single most important thing. And that's what Business Breakdown really focuses on. Like today on Ecolabs, has a huge advantage. They're so big. Like a good example, I didn't realize this, but McDonald's, there's two vendors. If you open a McDonald's franchise, there's two vendors you have to use. You want to guess what those two are? When you go to McDonald's, what do you buy? Most of it that you buy, McDonald's makes. What do you buy from McDonald's that they don't make? Coca-Cola. What's the other vendor McDonald's franchises have to use? Well, Ecolabs, kind of obvious, right? Because I'm talking about Ecolabs. So that's how important Ecolabs is. If you open a franchise McDonald's, you have to use Coca-Cola, Ecolabs. Why Ecolabs? Because they're just so good at what they do. But then they're talking about 15 years ago, they bought this water company. And what does that mean? What advantages they have? It's just really interesting. You get into the guts of Ecolab. You know if you should be a security analyst or not if you listen to Business Breakdown and you're really bored. You shouldn't be you should not be a security analyst. So I listen to those things, and not only do I love listening to them about Ecolabs or Compass, I love listening to them because they give me strategies for other businesses. So like we have a restaurant, like you've seen our restaurant in Costa Rica. We have a restaurant in Costa Rica. I listen to Business Breakdowns talking about restaurants like Chipotle, and it gives me ideas of what things we should do with our restaurants. It's really good at what is their strategy? How do they operate their business? How do they keep their employees motivated? How do they handle their vendors? How do they market it? How do they provide service to their customers? All that kind of stuff. Ecolabs is like 60% of their employees are salespeople, which doesn't sound great to me, but it does show they have a heavy sales focus. They're also an engineering firm. They do create new things, but it's interesting to get into the guts of the company and what do they do, what drives it. You want to understand that in an interview. What is a good company? What is it they're looking for? That comes down to fundamentals. What ratios do you follow? A firm that has an important brand, you're going to see them having great gross margins. So a firm with a good brand, they can charge more for their product. So they can have good gross margins. A firm that is really good at cost management, like a Walmart, you're going to see them having great margins, but tremendous turnover. And you should see that in the turnover numbers. Costco has the worst margins and the best turnover. And they're great at turnover. And I love the CEO of Costco. I might have told you all this before, but I just love listening to this guy. I think he's retired now. But he says the goal of Costco is to make as little money as possible. Does that sound like a good stock? And what does he mean by that? He wants their margins 3%, and then he's going to kill it on turnover. So thin margins, but killing the margin. And what does that mean? Every time he saves money, he finds a way to do things cheaper. He gives it all to the customer in cheaper prices. And then the turnover is huge. He just sells a bunch of stuff. I love that. In one sentence, he explained the entire strategy of Costco. You understand it exactly what they're after. So that's kind of business I'm looking for, that I can, in a few sentences, explain extremely well. What is it that makes them tick? Do y'all know how you express it in a Porter standpoint? What are the two things Porter came up with? I don't think I've ever clicked on a page and Trump wasn't the first thing there. What are two things Porter did? Buy forces and the generic strategies. What's the other thing he did? Have y'all heard of value chain management? Have y'all done that? You should become a value chain management expert. Extremely important. This is really where you're understanding what gives a firm an advantage. So if you're looking at Ecolabs, where is it that they're really good? Is it the inbound logistics? They were talking about that. What is Ecolab purchase? So we know China's kind of threatening to not let us get the precious earth, the lithium and those kind of things. Does Ecolab purchase any of that? And in the Business Breakdown, they say, yeah, they do have a lot of inputs, but they actually have 10,000 inputs, and none of them are particularly important to the price of their product, so they're pretty well diverse. So it's unlikely the battle going on with tariffs in China is going to materially impact their cost of goods sold. That's the inbound logistics. How do they manage that? Their operations, once they get that stuff in, how do they produce their product? The outbound logistics, how do they get the product to the customer? How do they market? So Ecolabs has this massive, massive sales force that knows their customers extremely well. Compass was another one. Boy, have y'all heard of Compass? So you probably have heard of Cisco Foods, some of these firms that, so it provides food services to a lot of places, but you don't hear of them because they used to be a UK firm and now they dominate the US. How did they dominate the US? By buying a bunch of US companies, and they kept the names of those US companies. So you don't know Compass, you know all those other companies, but it's amazing. These are amazing stories. The service after the sale, well, how do they handle that? And then the infrastructure of the business, human resources, technology, procurement, all of those things are going to impact the margins of the firm, impact their turnover, those kind of things. So this is the way you do it. And guess what? You go into Chat GPT and say, Chat GPT, give me the value chain management analysis of Ecolabs, and you'll get a pretty decent one. I don't know if I haven't done, what's the other one? DeepSeek? Have y'all tried theirs yet? So I don't know. I almost want to compare the two and see which gives you the better solution. What amazes me about ChatGPT is our library gives us a lot of these resources. They give us value chain management and Porter's Five Forces. I found ChatGPT often gives you a better solution than what the library provides. So it's pretty amazing. But those are the kind of things you're looking for. So when you're talking about portfolio management, your definition of what is a good company should be very, very deep analysis, something you can talk about in quite a bit of detail. What gets you excited about a company? What are you looking for? And your definition of a cheap stock is a little bit easier. It might be you want a low PE ratio or low EV to sales ratio or something, or you want them trading at the low end of where they've been historically. So those kind of things you want to have in your definition. So what do you do with that? Well, a portfolio, if you're going to build a portfolio, you need four things. You need a philosophy, you need a process, you need a construction. So you need a process for screening, a process for construction, and you need risk management. You need those four things. So if you're going to go into an interview, especially for a security analyst job, anything on the investment side, they're going to ask you, do you have a portfolio? Your answer to that's going to be what? Yes, you do have one. It may be paper. Paper is fine. You can go on the Bloomberg machine and build your portfolio there. And then they're going to ask you, well, how do you do it? Well, you need to go through this. So my philosophy is, this is what I believe. So your philosophy statement starts with the words, I believe, and that's where you're going to define the kind of stocks you're looking for that beat the market. So I believe these stocks with these characteristics will beat the market. There's all different ways you can do it. Do fundamentals, which is what I just showed you, turnover, margin, return on capital, and risk. It can be just quality related. Quality can be their credit ratings, reliance on accruals. There's certain industries that a big part of their earnings is based on accruals. We talked about that in my insurance class. A big part of insurance earnings is based on what actuaries are estimating. So you get a lot of uncertainty. Good management, it could be how volatile their earnings are, those kind of things. So GMO, you can go on GMO.com and you can register. GMO is huge on quality. GMO loves buying high quality firms, so you can see their definition. You can really focus on valuation or some combination of these. Valuation, you want cheap stocks. You could focus on technicals. We talked about that earlier. Technicals and just looking at price motion and trying to find stocks that are too cheap. You're going to buy them on the bounce before they bounce back. I've talked to a lot of portfolio managers that are thematic investors. They might have a China play. Right now, they may have a tariff play where they're going to pick stocks that have fallen a bunch because of the tariffs, but aren't really that exposed to tariffs, and they're going to try to get them on the other side. Some might have an Africa play, that Africa has a young population, and they're going to eventually become consumers. You might have an India play. India's economy is growing pretty rapidly. You might have a baby boomer play. That was a big deal in the 70s. There's a famous book called The Pig and the Python. It's watching the baby boomers go through the python. So in the 60s, they were having babies. So baby food was a big selling item. In the 70s, they started buying houses, so real estate was doing really well. In the 80s, they started being mid-career, so they were buying cars and fancier houses and vacations. Then in the 2000s, they started getting ready for retirement. They started buying more bonds. They started thinking about retirement homes and down, all this. And you could just watch that go through. So that was a thematic. You might have a thematic of AI. You may have a thematic. One thematic I like is innovation. What are those firms that are going to change the world? Looking for those type of firms. So there's a lot of thematic investors. They tend to be top-down type of investors where they have a major theme and they're going to look for stocks that meet that theme. The AI theme might not be what are the firms producing AI, but what are the firms that are going to take AI and make their processes better, like Duolingo. And, right now we're focused on NVIDIA because they're building the chips, but who's actually going to buy those chips and make their business better? That could be a theme. And you might want to backtest it. Backtesting is really, really difficult to do, mainly because when you go back and backtest, you have something called survivor bias. If you say, hey, I wonder if this philosophy would have worked in the 70s. Well, the problem is when you pull up stocks in the 70s, the only ones you get are the ones that are still in business today. What you don't have are the stocks that were around in the 70s that went out of business in the 70s. And so when you run your model, you might say, well, my model really works well, but it might be because your model would have had you buy a bunch of those stocks that went insolvent, but since you don't have them anymore, you don't have that data. So that's called survivor bias. So obviously the firms that survived did well because they're still here today. So it's really, back testing is very, very difficult to do. And it's not just because firms go insolvent, but you also have firms that merge with other firms and they just disappear. So it's really hard to go back and test stuff back years ago. What most hedge funds do is they incubate their ideas. And so they test it with live data for 3 or 4 years. So rather than back testing, they're kind of forward testing. And once they see it works for 3 or 4 years, then they'll try it. So what is your philosophy? Well, if you don't have one, go steal one. So what's the most popular? Anybody know what the most popular strategy out there is? If I give you the initials, can you figure it out? It's called GARP. You know what GARP is? Any guesses? What do you think the G might stand for? What are you looking for? Growth. What's A? It's a really, really small word. At A. What do you think the RP are? Well, it's right up there. Reasonable price. That's GARP. If you don't have a strategy, just use GARP. It's so easy. What does growth mean? You want firms that are growing. What does reasonable price mean? You want them that are growing that aren't expensive. So simple. We did that in my model, didn't I? I had revenue growth in there. I had EBITDA growth. I had growth in there. And then I look at the valuation. So GARP is the most popular one out there. There's others out there. There's some that are dividend-based strategies, some that are free cash flow-based strategies. One I do like is free cash flow yield. There's a famous book on that called Shareholder Yield. I don't know if the book will come up or not. That's not it. But there's a book, I forget the guy who wrote it. Surely it will come up. Here it is. This is a great book. It's a short book. But their whole philosophy is they want to buy firms that are producing a lot of free cash flow. But their theory is free cash flow is hard to measure. But what is not hard to measure is how free cash flow is deployed. So it's hard. There's a lot of debate. If you take Packham's class, he talks about free cash flow, but it's really hard. There's no financial statement that gives you free cash flow. You can't look it up. You got to calculate it. Everybody has their own definition. And what this firm says, William Priest, what he says is forget about calculating it because there's just too much debate. It's too difficult. But if a firm is producing free cash flow, you're going to see it. They're going to be paying dividends. They're going to buy their stock back. They're going to be paying down debt. They're going to be doing a lot of CapEx. Firms that have a lot of free cash flow are going to be doing those kind of things. So that's how he defends it. In fact, I visited his firm the year I retired. I went up to New York, visited his firm. I didn't really want to talk to his firm. I just wanted him to autograph my book, and he wasn't in that day, so I didn't get his autograph. So I had to sit and listen to the whole sales pitch. But anyway, this is a really good book. It's only $22, but really, really good book. It's a little tricky if you read it. It looks like, wow, I could do that. Really simple. And then they put an appendix in with this really crazy math just to try to convince you, no, you really can't do it. You need to hire us. But it is a fairly simple approach. So that's another one. You could be a free cash flow yield investor. You want firms that have really good free cash flow yield. You read that book, you can copy other people's ideas. You probably want to say that you copy. You probably don't want to describe this like you came up with it for the first time. So if I were in an interview, I said, man, I read William Priest's book on free cash flow yield. I like that idea. You can, make it sound a little better by saying, yeah, some of the things he's doing, I don't think it really works. So I made my own changes. That sounds a little better. But get something so you can talk about what you believe as a philosophy. I am a value investor. I like firms with good numbers that aren't that expensive. Obviously, they don't exist all that much. So I love Costco. It's a wonderful firm, but it's expensive. I love Ecolab's, a wonderful firm, but it looks expensive to me. I used to love Walmart, and it's cheap. Now Walmart is a good company, and it's really expensive. So you're looking for those kind of things that look interesting to you. That's why I listen to Business Breakdown, because I'm convinced, yeah, this firm has something going on. Let me look at the valuations and see what's going on. Maybe I can invest in this firm. And that's why I bought Meta a few years ago. When Meta hit $100, I was like, okay, Meta's still a really fundamentally good firm. It's obviously worth a whole lot more than $100. So that was a great company that was really cheap. Why? Because they were doing too much CapEx on virtual reality and Meta and all that stuff. But they still had their base business that was wonderful. So you do this type of philosophies. I have another philosophy, which is really cheap. So every once in a while, I'll go in and look at the stocks that have performed the worst the last 52 weeks. And I'll try to find something in there that could recover and come back. And so I'll look at them. Maybe they're going out of business. But have you ever tried that? Just take what are the stocks that have fallen the most the last 52 weeks and go look at them. So that's when I bought Uber. Uber stock had fallen so much. I bought Uber. Why? Because of COVID and all that kind of stuff. But it's still a good company. I bought it. And I was great on both Meta and Uber, except for I sold them too fast. But I was right. They both doubled in value. So I got 100% and then they kept going. So I got out too fast. I mean, Meta went from 100 to over $500. So they really recovered really fast. So always philosophy. Just have a philosophy. If you don't have a philosophy, copy somebody else's and just make it your own. That's perfectly legal. All right, I don't know why we're on time. All right, we're good on time. All right, once you have your philosophy, you've got to somehow find a way to find those stocks that meet your criteria. And I just showed you that with the screening model. That's what a screening model does. You can find screening models online. If you have a broker, your broker may have a screening model. Bloomberg has a screening model. I prefer to do it in Excel like this because I just have more control over the data. But a screening model. So look at your philosophy. Whatever's in your philosophy, if it's growth, if it's earning stability, it's return on capital, whatever it is, that needs to be part of your screening process. Now, your screening process can be the computer. Your screening process can be you working individually on the stock, or it could be both. What most people do is they take the computer and they screen it down to a reasonable list of stocks they can work with. So if there's 500 stocks in your industry, you don't have time to look at 500 stocks. Because you're going to need like 50 to 100 hours per each company. You don't have that many hours. So let the computer get it down to maybe 20 stocks, and then you're going to do deep research on those 20 stocks. Something along those lines is what you're looking for. Choose your index. So I use the Russell 3000. You'll probably also choose your sector. You're probably not going to be analyzing all 3,000 stocks. You're probably going to pick tech stocks or consumer discretionary, something along those lines. You just don't have enough time to look at all of these things. So you're going to use that to screen down to some stocks. You may have a buy list. You may have a short list. So you get down to a short list of 10 stocks. Then you're going to go and look at each one of those. You might find that in your philosophy, one of the things you have is called management. Well, the computer's probably not going to screen for good management. I don't know what you would put into a computer. Say, give me firms with good management. You can look at their degrees, and I would almost want to kick out anyone that has a degree from Harvard. So I don't want firms, yeah, if y'all contrasted MBA and Boeing, what's the difference in those two companies? One of them was run by a Harvard MBA, one of them's run by an engineer who builds airplanes. Which do you think is which? Which one's struggling right now? Boeing, that's the one run by a Harvard MBA. Which one's excelling really well? MBA, why? Because that's, so yeah, I like CEO, complicated firms. I like CEOs who have the technical side down. I like the Harvard MBAs. It just makes you feel, if I'm going to buy a pharmaceutical, I'd much rather a scientist be the CEO than some Harvard MBA. That's just my view of it. But how do I figure that out? I don't know if I can do that with a computer. I think that's going to be really, really tough. One thing I do on management is I go find management. Most management of major firms have been interviewed on YouTube. I just go find their YouTube and just listen to them. That's how I found the CEO of Costco. And I love that with Costco, that he could sit down and explain his business in a few sentences. And I say, I see exactly what you're doing. That's what I'm looking for in good management. I remember listening to McDonald's management. It was pre-management. They were at an investment conference. The more he talked, the more I was like, this guy doesn't get it. He's like, everything's fine at McDonald's. We're doing exactly what we need to do. It's like, what's your strategy? It was so blasé. It's like, no, McDonald's has got some serious issues. They really need to address it. So they got rid of him, and the new person came in, and they've done a lot better since then. But yeah, I like to hear management. Bristol Myers, I listened to their CEO. He is a scientist. A lot of what he's saying sounding good. And then he talked about what they were doing with these mix of drugs. And it's like he was going to be causing the cost of healthcare to skyrocket. And I was like, no, I don't want a pharmaceutical that's going to be making a bunch of money off of Medicare and the taxpayer. I want someone in healthcare that's actually making it more productive. So, I'm listening to management, what they're saying, but that's a tough one. So some of this you can use with the computer. Some of this you're gonna have to just sit down, roll up your sleeves, and do some legwork. Can you visit the firm? You can certainly do that. Walk into a JCPenney. What's going on in JCPenney? Pretty boring stuff, right? It's pretty unorganized when you walk in there, isn't it? It takes you forever to find anything. Not a good firm in my opinion. Costco, I walk into a Costco and the guy met me at the door. That guy was incredible. I don't know how they pay this guy, but he was helping me out while he's giving another person their basket and saying hello to everybody. He was like, they must pay him a bonus for cheerfulness. Really impressive. I walk into a Walmart. Have you ever bought a computer from a Walmart? It's about the most depressing thing you can do. You can ask the sales rep and they're like, oh, I don't know. It's a computer. If you ask any question, they'll pick up the box and read the box to you. It's like, no, that's what I'd rather go to Best Buy, have it explained to me, and then I go home and buy it on Amazon. But visiting the firm is something you can do, interact. One thing with a firm like Oracle, how do I figure out Oracle? Well, who buys Oracle's products? It's B2B. What is B2B? Business to business. Who buys Oracle products? USAA, Walmart, Costco. So whom do I want to speak to? I want to go talk to the IT person at USAA and hear, how do you like Oracle? How do you like dealing with them? And they say, we hate them. They're the worst company ever. They used to say that. Oracle's trying to fix their image. But why do you use them? Well, they're the only one we can use. Why don't you use Salesforce? Well, if I use Salesforce and it doesn't work, I get fired. If I use Oracle, everybody uses Oracle. What do we call that? What does Porter call that? Anybody know? Have you heard of switching costs? So what's Oracle's big advantage? Switching costs. We don't want to switch. It's too much work. It works. That's kind of Ecolabs. Ecolabs has a huge switching cost. When they build a new McDonald's restaurant, they actually build Ecolabs into the restaurant. What if you want to use someone besides Ecolabs? It's going to be a major pay to switch. So that's the kind of thing I'm looking for. So yeah, these are kind of things you're going to put into your list of what you're looking for. A lot of it you're going to learn as you get experience and figure out what's important and listen to other people. That's why we're going to, in secure analysis class, we're going to bring in a lot of experienced people to come listen to the students' presentations. I'm hoping they'll be tough and not cruel. We'll see. We've had some cruel ones come in before, but be tough and really challenge them. Our CFA research team, they made it pretty far this time. Their expertise was on the Q&A. And how do you do well on a Q&A? You know the details on the firm. You know their M&A, you know their management, you know their key numbers. And that's what I told the team. You've got 5 people, have one person focus on nothing but M&A. So if an M&A question comes up, they can go in detail in it. Have one person focus on management. Who's the CEO? How old is the CEO? Who would replace the CEO? Who replaced the CEO last time? Did they go internal or external? You need someone that can answer. And that this team, I think the reason they made it to round 4, I mean, they were in the top 40 out of over 1,000 schools. They made it really far. I think the Q&A is where they just excelled so well. You want to be like that in an interview, that you can go into that kind of depth. And that's why in the fall, I'm going to emphasize that with students as well. Make sure you can answer those questions about the firm. And business breakdown does that. So that's why I push that so much. All right, so now you've got your stocks that you want to buy. You have your buy list. Well, how do you buy them? You don't just go out and start buying them. You have to do portfolio construction. You could make it simple and just put the same percentage in each one. So if you have 100 stocks, just put 1% in each one. You could do that. Problem with that is you might end up with 10% of your portfolio in tech when tech is 30% of the index. So you're making a big bet against tech. Do you want to do that? That may not make sense. So you might say, well, tech is 30% of the index. So I want 30% in tech, but then I'm going to take my tech stocks and equally weight them within that 30%. You could do that. Those are the kind of things you have to think about. Equal weight does work well, but equal weight is a value strategy. You think about growth versus value. Growth stocks are expensive. Value stocks are cheap. So if you equal weight, you're really going to be overweighting value stocks versus growth. So growth does well. Equal weighting will underperform. So you got to be aware of that. Equal weight also does market cap. If you equal weight, you're going to overweight small companies and underweight large cap companies. So what is equal weight? It's essentially small cap value. So how is equal weight done the last few years? Horribly, because small cap value is done horribly the last few years. But over the long term, small cap value is done well. You could do fundamental rate weighting, and you should go out and read these papers. Robert Arnott versus, go out and find this and read this. Robert Arnott versus Cliff Hasness. Factor fight, what I just say, factor models. The factor timing debate continues. You can probably find them on YouTube. I love Cliff Hasness as a speaker. He is really good. He actually wins awards over and over again for his articles. One thing with this article, he always tries to have a really provocative name. Sometimes you have to actually blur it out because it's too explicit, but he likes provocative names. That might get you to go read his papers. But he's won a lot of awards. Robert Arnott, one of my favorite people. I've never met Asness, but I have met Robert Arnott a couple of times. Really great guy. They disagree with each other. You might think they don't like each other, but they actually have tremendous respect for each other, and they debate hard in public. They're really, really after it. Both of them are giants in the industry. It's Cliff Asness doesn't like fundamental weighting. Arnott is the big pusher of this, and that's his thing. Asness says fundamental weighting is nothing than value investing. When you do fundamental weighting, you're essentially buying more value stocks and growth stocks. Arnott understands that and says yes, but it still works and you should do it. So the two of them have a debate. So read, that's the kind of stuff I'll be reading. It's like 10 times better for you than textbooks. I just promise you. It's what people are talking about, what they're debating. Lance at USAA, now at Victory, he created a fundamental weighting model for USAA for theirs. They call it, well, you probably have heard this term. Smart beta. Does that sound familiar? Have you heard of smart beta? So fundamental weighting is sometimes called smart beta. Here's someone who's going to explain it to you. So it's a way to put together an index. So it's index investing, but in a way that you don't use market cap. So if Apple's 7% of the index, you put 7% in Apple. Smart beta says, well, we want to be passive. We want to buy the index, but we don't want to put 7% in Apple. So we'll look at something besides market cap. Maybe we'll look at revenues. Maybe we'll look at net income. Maybe we'll look at book value. So that's what this is. It's fundamental weighting. So there's two ways to talk about fundamental weighting. You can call it fundamental weighting, which Robert Arnott is the guru for that. And some people call it smart beta. I call it smart alpha because it really is alpha. It really isn't beta, but you know, you can have that debate. Some say, you know, we're going to be pretty close to the market, but we'll give ourselves a little bit of room. So if Apple is 7% of the market, we'll put maybe 6.75% in Apple if we don't like it, or 7.25% in Apple if we like it. That's called enhanced indexing. I've done a lot of enhanced indexing in my life. You can do it based on your model. You can give each of those stocks a score. If it gets a score of this, you put this much into it. That can work. Some, especially hedge funds, have optimization models, which includes trading costs. So you can say, okay, here's the stocks we want to buy. The most optimal way to buy them is in these percents, but here's their trading costs. So it doesn't make sense to trade this one yet because the trading costs are too high. So these get pretty intense. There's one firm I use that did this. They traded once a month. And so I remember Joe, the guy who sold for me, he hasn't called me in a while. I don't know what happened. He used to play professional baseball, and then once he got injured, he became a stock investor. But he used to call me, and anytime he called me, we were on the phone like 2 hours, and I figured out why, because they only trade once a month, and the rest of the month they didn't have much to do. So he just call and talk about anything. I love talking to him because he gave me a lot of insight on the industry. In fact, that's the firm, y'all know the rolling beta that you're doing. That's the firm that gave me rolling beta. I copied that from them. But yeah, they have an optimization model and they run it once a month, and the rest of the month they just sit around talking baseball. An impressive firm. It's an enhanced indexing firm, but that's the way they do their model. So that's your construction. I would recommend you might try equal weighting to start because it's the easiest to do, but you do have to worry with equal weighting is when do you rebalance? Because if you put 1% in 100 stocks, a week from now, you're not going to have 1%. You're going to be all over the place. When do you move back to 1% in each stock? There's many papers written on that. Most common is to say once a quarter, go back to 1% in each one of the stocks. But, you know, there's different approaches, different arguments on that. So have some idea on portfolio construction that you would follow. If you're not sure, just pick one and go with it. I tend to be very conscious of where my industries are. Because if technology is 30% of the market, that doesn't mean I want 30% in tech, but I probably don't want 5% in tech because that's a pretty big bet against tech, although that probably would have worked pretty well this year. So, but I'm always conscious of how far away, and that's what I love about the portfolio function on Bloomberg is they'll do that sector analysis for you. How much of your return is because you picked the right stocks, and how much of your return is because you have the right weights on sectors. And that's, you want to be conscious of that. So philosophy, process, construction, and the last part is risk management, known as your sell discipline. How do you know when you're going to sell a stock? And we always ask this question at USA, the managers, and when we asked this question, they all got real serious. They cleared their throat. They knew they had to give us a really strong answer. Why is that important? Well, retail investors sell their gains too fast and hold on to their losers too long. Why? Because of ego. They like to sell their gains so they can say they made money, and they hold on to the losers because they're just hoping it'll come back so they don't have to admit they made a mistake. That's why sell discipline is so important. It's to take the emotion out of it. It's to take your ego out of it so that you can make a decision that's not driven by really bad biases. There's several ways you can do it. Some firms, they say, we have a target price. So we think the stock's worth $100. We bought it for 70. When it hits $100, we're selling it. So that's one approach. Some say, hey, if the stock falls a bunch, we obviously made a mistake. Once it falls 10%, let's get out of it. Now, the problem with that is if the entire stock market falls 10%. So I tend to say, I bought a tech stock. If it underperforms tech stocks by 10%, then I must obviously made a mistake. Let me sell it and go find something else. I messed up. My ears just popped, so I feel like I'm talking in a echo chamber. Did y'all notice a difference, or is it just me? I don't know why they just popped. I don't have a cold or anything, but that's really strange. All right, so have some rules. So I would probably say, hey, here's my benchmarks. So I was doing consumer staple travel stocks, and there's 50 of them. And I bought these 3 travel stocks. Travel stocks are up 10%. One of my travel stocks up 15, that's good. One's up 12, that's good. One's down 5, okay, that's not good. I made a mistake. Let's cut our losses, let's get out. And you make it very, very strict. You don't say that's what sells this one unless we find some reason why we, no, you got to take the emotions out of it. So some way to say we were wrong, let's get out, cut our losses so we don't destroy this thing, because your ego will not let you do that. This word catalyst is pretty important. As part of your philosophy, I should probably put that in there. What catalyst means is you're looking at stocks that are really good, but the market hasn't figured it out yet. What a catalyst is what will it take for the market to be where you are? Is that going to be the next quarter's earnings? It's going to be maybe a new CEO comes in. So you need to think in terms of catalysts. I would work the word catalyst into your discussion. The best way to do your philosophy and your process, what your manager, what people want to hear is this phrase: what the market is missing here is. That's what your boss wants to hear. I can spell what, it's a little better than that. You want it really clear, but you can improve it. And the catalyst for them to see that is so, hey, and I've had several examples of this over time. I wish I recorded some of them, but I remember Jason on Apple may have told you this story before, but he hit it just right. So he said, what the market's missing here is they are assuming Apple's margins are coming down. I think I told y'all that, didn't I? Well, I can't remember. But I think the market's wrong. I think their margins are actually going to hold, even improve. And they're going to see it in the next 2 quarters of earnings release. So this is what the market's missing. You have to add another phrase here. What the market missing here is because, and the catalyst for them to see that they're wrong and I'm right is this. If that catalyst is when they hire a new CEO and the current CEO is 45 years old and has no plans of ever retiring the rest of his life, yeah, the market's going to see this over the next 20 years. It's like, yeah, that's a little slow. Market's going to see this with next quarter's earnings. Yeah, that's pretty fast. That's a good stock purchase. This is how you make your career as a security analyst, is you can say these kind of phrases in a convincing way that people see why you're buying the stock, and it's really obvious. Who's the best at this? The Motorin. Motorin, you should listen to all of his videos, read his books. He is excellent, excellent, excellent at. And he even has a video called Storytelling. How do you take your stock idea and convince people that you got a story to tell? So there's the quant, but you got to convert that quant into a convincing story that people are like running out to buy the stock because you got them so pumped. I think Business Breakdown does that as well. Although Business Breakdown doesn't focus as much on valuation, it tends to focus on what's a good company, not so much on what is a good stock. They do a little bit of that. They talk on Ecolab a little bit of that. If you're not doing it, start doing this. If you're interested in investments, you're in an investment class, so assume you're somewhat interested in it. So if you're interested in a career on the investment side, you need to start doing this. It doesn't matter if you mess up, you make mistakes. The whole key is to get started so that you start learning. So, all right, I'll let you out a couple minutes early.